Should you buy a property in Australia right now or wait for a market crash? That is the question everyone is asking and seem to be feeling completely paralyzed by the property market today. We are seeing one of the most confusing and heavily debated property markets in Australian history that is unfortunately run by people who have little to no control of what to do. On one side, the big four banks are downgrading their growth forecast because of the new federal budget tax updates. On the other hand, the national median across the country has crossed $1 million for the first time, and some suburbs are still growing at over 15% annually. If you are waiting for the media to give you a clear green light to buy, you will be waiting forever. So today, I'm breaking down the 5 key factors that are impacting the market from all the directions, reviewing the data from the major lenders, and mapping out what the next 12 to 18 months would look like so that you can make an informed decision for yourself and your family. The fourth one is definitely something that will continue to drive demand for longer. And if you are new here, I'm Adeal from Ariza Buyers Agency, where we help Aussie families build wealth using property, giving you the freedom to enjoy your life on your terms. So if you like content like this, click subscribe as we got more educational content coming your way. Right now, the single biggest issue facing both home buyers and investors is hesitation. The idea of not knowing whether there will be more taxes or more RBA rate hikes or international conflicts. Affordability is holding off by a string. Inflation is sticky, and policy shifts have created a huge gap between what people want to do and what people can do. To help you understand the current market, we need to examine 5 major players of Australian property market right now. Let's break them down one by one, using the latest data from the RBA, the big four banks, and the data from the government policies. The first and the most dominant player shaping the market is the Reserve Bank of Australia, RBA. Following 3 rate hikes this year already to fight inflation, the official cash rate is sitting tight at 4.35%. For anyone trying to buy, this has been a major blow to their borrowing capacity. But here's where the story gets interesting for the next 12 to 18 months. As of June 2026, the economic data is showing significant slowdown in the GDP growth. Because the economy is cooling faster than expected, 3 of the big 4 banks, CommBank, ANZ and NAB, have officially updated their forecast, predicting that the RBA will hold the cash rate stable at 4.35% for the rest of 2026. Only Westpac still believes another rate hike in 2026. Interestingly, CommBank and NAB have actually come forward and even predicted that the RBA's next move could actually be lower. Now, when will that happen? That's still unclear. But the belief is that it is because of the slow GDP growth of only 0.3% in the March quarter and just 2.5% growth compared to the year ago. Slow GDP and the bank's confidence of lower interest rates means that the time of rapid rate hikes is probably behind us. Lenders are already reacting to this. In fact, we are seeing competitive rates, especially the 2 and 3 year fixed rate loans being now offered to win new business. This all indicates that the rate environment is now moving from a state of shock to a state of stability. The second major factor is federal government's fiscal policy. The recent 2026 budget introduced major structural changes by moving forward with restrictions on negative gearing for established properties and shifting the 50% capital gains tax discount to inflation indexation model. Learn more about it in the video linked below. On June 4, 2026, CommBank's senior economist released major report noting that the market sentiment had softened rapidly following these budget changes. CommBank actually downgraded its national housing policy outlook for the rest of 2026 to flat because of this policy shockwave. Let's look at a quick calculation to understand the friction. If you purchase an established investment house today that runs an annual loss of $6,000, under the old rules, you would deduct that from your salary and get an immediate tax refund of around a couple of $1,000s, which will help cover the mortgage. Under the new 2026 rules, that loss is ring-fenced. It's banked for later, meaning your week-to-week out-of-pocket holding costs are now higher. This has caused the casual, uneducated investors to panic and exit the market. But remember, this policy applies strictly to established property only. The government has left new construction completely untouched to encourage more supply. This policy friction is creating a short-term dip in competition, which is exactly when an intelligent buyer steps in. The third major player is the banking sector, governed strictly by APRA's guidelines. Even if the interest rates remain on hold, the banks are enforcing a silent credit fence. Right now, if you apply for a variable loan at 6.5%, the banks don't assess your ability to pay at 6.5%. Under APRA's guidelines, they must add a 3% serviceability buffer, testing your household income at a theoretical interest rate of 9.5%. On top of that, banks are strictly monitoring your debt-to-income ratio, limiting total liabilities at roughly 6 times your income. CommBank's June 2026 data projects that the new investor lender volumes can drop significantly significantly as compared to last year. Why? Not because people don't want to buy, but because the bank's assessment calculator says no. If you are trying to buy a home or investment right now, your primary focus shouldn't just be finding the property. It must be to optimize your credit file, closing down unused credit cards, getting rid of short-term debts, and structuring your loans cleanly as standalone loans rather than cross-collateralizing to make sure that the banks don't reject your loan application. This brings us to the fourth and arguably the most powerful force in the entire property ecosystem, the supply shortage. While taxes and bank rules try to slow the market down, basic economics is pushing it right back up. According to the latest Cotality National Home Value Index, the Australian rental vacancy rate sits at a staggering low of 1.6% only. To give you some context, a balanced property market requires a vacancy rate of around 2.5 to 3%. In cities like Adelaide, the vacancy rate sits at a staggering low of 0.9%, and Perth is sitting at 1.1% only. Because there are simply not enough homes for our population, the national rents have accelerated again, growing at roughly 5.7% in the last 12 months. And our government that pledged $10 billion, yes, billion with a B, to build new dwellings has only completed a little over 1,400 homes, which brings the average value to about $7 million per house. I have no idea how they can call it affordable housing. Anyway, the thing is, no matter what the government does with taxes, or what the RBA does with the interest rates, you cannot tax or interest rate your way out of a physical shortage of houses. Australia is currently building tens of thousands fewer homes per year than what our population actually needs. This supply crisis creates a highly defensive and virtually unbreakable cycle of long-term capital growth. The fifth and final factor that you must understand is the extreme divergence in the market right now. There is no single Australian property market. Instead, we have a clear two-speed market. Let's look directly at the raw numbers from Cotality Home Value Index. Sydney and Melbourne are navigating the early stages of a minor cyclical downturn. Sydney's monthly growth flattened to a negative 0.1%, while Melbourne dipped by 0.2%. Higher median prices and tax changes are causing these markets to take a dip. Meanwhile, the mid-sized properties in other capital cities and good regional towns are increasing at a record pace. Perth recorded a massive 2.5% monthly growth, pushing its annual returns to an astonishing 24.3%. Brisbane climbed 1.8% for the month to an annual growth rate of 19%, with its median prices sitting comfortably above $1.1 million. If you are a beginner looking at the headline news saying, property is slowing, then you are not reading the data. Sydney and Melbourne are pulling the national average down, while the northern and western states are still doing very well. Your success right now depends entirely on which state and suburb you buy in. So, let's paint the picture for the next 12 to 18 months. What should you expect if you enter the market now? For the rest of 2026, expect a continued window of hesitation. Headline price growth across the capital cities will look flat or modest. Investor lending will, for the time being, drop off as the people digest the new budget changes. For owner-occupiers and prepared investors, this is your golden window to buy against the cycle. Competition at auctions will drop, the vendors will become more realistic, and you won't be fighting 50 other buyers at an open home. In 2027, it's very likely the situation won't be the same. As Combank's research highlights, home prices are expected to stabilize and begin a clear recovery cycle moving into 2027. Why? Because borrowing capacity will naturally increase as wage growth catches up with interest rates, and higher rental yields will eventually pull the buyers right back into the market. If you wait 12 to 18 months to buy, you will be buying in a market where interest rates may fall, sentiment is hopeful, and the pent-up demand triggers another wave of FOMO. Buying before that cycle begins is how real wealth is generated. Think of what happened with uncertainty in 2020 due to COVID, and how the property market climbed in 2021 and 2022. If you want to move forward in the current environment but want to navigate through the risks and ever-changing government policies, here are 3 alternate paths that we are executing for our clients right now. Target the new build loophole. Because the new budget guidelines preserve the classic negative gearing against your ordinary salary exclusively for new residential supply. Selecting premium, highly weighted, brand new houses and townhouses in major growth corridors lets you retain your tax deductions legally. Execute a borderless growth strategy. Stop looking in your backyard if you live in Sydney or Melbourne. The affordability and structural demand are in the high yield and growth corridor of Southeast Queensland or established infrastructure pockets in Adelaide and Western Australia. Look at the data, not your local street. And lastly, incorporate debt recycling. Talk to your mortgage broker or financial advisor about structuring your current owner-occupier mortgage. By funneling your surplus income through an offset account and utilizing split loans to invest, you may turn non-deductible personal debt into tax-deductible investment debt, maximizing your cash flow efficiency. The current property market is not a red light or a green light. It is a filter to remove the people who are hesitant and afraid to take the next step, leaving room for serious buyers only who care about achieving genuine financial freedom. History proves that the people who had the courage to buy real estate during times of media panic and regulatory shifts are the ones who look back 5 to 10 years later and realize that it was the best financial decision they ever made. Don't let the market confusion cost your family's future. If you're sitting on the fence wondering if your borrowing capacity is enough, or unsure which state or suburb suits you, let us help you clear up the confusion. Click the link in the description below and book a call with our team. We will review your current situation, look at your numbers, and help you map out a customized roadmap towards your next property. Stop watching the news, start analyzing the data, and let's build your property plan together. I'm Adeal, and I look forward to seeing you on the call.